If you've been learning trading for even a few days, you've probably heard about candlestick patterns. Hammer, doji, engulfing, morningstar. And if you search on YouTube, you'll see people saying, just learn these patterns and you'll start winning trades. But I started wondering something. Do these candlestick patterns actually work, or are traders just repeating things they heard from someone else? So I decided to test it. I backtested 10 of the most popular candlestick patterns used by traders across hundreds of trades. And the results were surprising. Some patterns worked, some completely failed, and one pattern performed much better than the rest. So in this video, I'm going to show you the 10 patterns I tested and which ones actually worked. Which ones failed badly, and the biggest mistake traders make when using them. Let's start with the basics. Before we look at the results, we need to understand something important. Candlestick patterns are not magic signals. They simply show the battle between buyers and sellers. Every candle tells a small story. For example, if a candle has a long lower wick, it means sellers pushed price down, but buyers pushed it back up. That's rejection. If a candle has a large body, it means one side had strong control. Buyers or sellers dominated that period. So when traders study candlestick patterns, what they're really studying is market behavior. But the problem is most people use these patterns without context. They see a hammer anywhere and buy. To keep the test fair, I used a simple structure. Each pattern was tested on 100 trades across the same market and time frame. Same risk management for every trade. Risk box 1%, reward fracture 2%. That means a 1.2 ratio. The patterns I tested were hammer, shooting star, bullish and bearish engulfing, and doji. Morning and evening star, inside bar, pin bar, and 3 white soldiers. Now let's look at the results. The hammer is probably one of the most famous candlestick patterns. It has a small body and a long lower wick. This pattern suggests buyers rejected lower prices. During backtesting, the hammer had a win rate of about 42%, which means it was slightly profitable with a 1.2 risk reward. But there was a catch. Hammers only worked well when they appeared at support levels. When they appeared randomly in the middle of a chart, they failed most of the time. So the hammer itself isn't powerful. The location is what matters. Next was the engulfing pattern. This is when one candle completely covers the body of the previous candle. A bullish engulfing suggests buyers suddenly took control. During testing, this pattern performed better than expected. The win rate was around 48%, which made it profitable with a 1.2 risk reward. But again, context mattered a lot. Engulfing patterns worked best after pullbacks in a trend, not during sideways markets. Now let's talk about the doji. A doji forms when the open and close price are almost the same. This means neither buyers nor sellers won. It represents indecision. Many traders think dojis signal reversals. But during backtesting, dojis performed very poorly. The win rate was only around 35%, which means most trades failed. This happens because a doji is simply a pause in the market, not necessarily a reversal. So using dojis alone as trading signals is extremely unreliable. Next up, let's look at the morning star and evening star. These are powerful 3-candle reversal patterns. The structure looks like this: a strong trend candle, then a small indecision candle, followed by a strong candle in the opposite direction. During the test, they performed moderately well with a win rate around 44 to 46%, better than random, but not extremely strong. They worked best on higher time frames like the 4-hour and daily charts. Now let's talk about the inside bar. This pattern signals market consolidation. The entire candle forms within the previous candle. Many traders use it for breakout trading, but there's a problem. During testing, inside bars had many false breakouts. The win rate ended around 39%, meaning most trades failed. They appear too frequently to be reliable on their own. Finally, we have pin bars. These are candles with long wicks and small bodies representing strong rejection. During the backtest, pin bars performed surprisingly well. The win rate was around 50%, which made them profitable with a 1.2 risk reward. but again, only when they appeared at key levels like support, resistance, or after liquidity sweeps. Without context, their performance dropped quickly. Next, let's look at the three white soldiers. This pattern is a sequence of three strong bullish candles. For this to be valid, each candle should have a relatively large body and close near its high, signaling that buyers are in total control throughout the sessions. During testing, this pattern actually had one of the highest win rates, around 53%. It was the most reliable pattern in our backtest. But there's a trade-off. It appeared much less frequently than others. So while it was reliable, it didn't generate many trades. After testing all 10 patterns, one thing became very clear. Patterns alone don't have much power. What really matters is trend direction, market structure, support and resistance, and liquidity zones. These are the four pillars of context. When a pattern like a pin bar aligns with a key support level in an uptrend, its success rate skyrockets. This is called confluence. But when patterns appeared randomly, without any level or trend behind them, they failed most of the time. They were just market noise. This explains why many beginners struggle. They spend weeks memorizing every pattern in the book but ignore the story the market is telling. The real secret isn't finding the perfect pattern. It's using patterns to confirm what the bigger picture is already telling you. Instead of using patterns as entry signals, use them as confirmation tools. Here's an advanced framework to boost your edge. First, identify the trend. Look for clear market structure with higher highs and higher lows in an uptrend. Second, mark your key levels. These are your value areas where institutional buyers and sellers are likely to step in. Third, wait for price to reach those areas. Don't chase the market. Fourth, only enter when you see a high probability pattern like a pin bar or three white soldiers. This way, the pattern becomes the final confirmation layer, the last piece of the puzzle, instead of the entire strategy. So, after backtesting 10 popular patterns, here's the truth. Patterns are a statistical representation of human behavior, but they carry no weight without context. Think of patterns as a tool in your box, valuable, but they can't build the house alone. To reach professional mastery, you still need strict risk management, emotional discipline, and a detailed trading journal. If you found this series helpful, I'm planning to backtest RSI strategies, moving average crossovers, and breakout systems next. Make sure you subscribe so you don't miss those results. And let me know in the comments, which indicator should I put to the test next? Thanks for joining this experiment. I'll see you in the next backtest.